Good afternoon, good evening. It is 7:04 p.m. Pacific Standard Time, 3/1/2014. Now, this is part 3 of the actual S&P part 1 and part 2. Now, what we are doing is we're going to add these fear indicators called the Market Volatility Index, CBOE. It is a fear gauge. Now, one of the things that we're going to do is I'm going to take this trend line, and every time we're going to go back to the 5-year anniversary on the fear indicator. So when fear was at its highest point ever, it was right up here in 2008 and 9. Now, listen, everybody doesn't quite understand what the fear indicator is. It's very simple. I will make it simple. This is a monthly chart, and the lower the fear indicator is, the more complacent people are. Everything is as good as you could want. There's never going to be no problems in the world. Nothing can go wrong. And right about that time, markets are peaking out at their all-time highs. So when we go back to 1996 over here, when we had sell-offs on a monthly level spike, then markets were selling off and fear got high. But then they came straight back down. Now, when we get into the 1999-2000 area, which means that this was a very tight area, and in 2002, we were putting in a reading up here of around 46. Now, when this was at its high, markets were at the low. So in year 2002, when we started that bull run in October, we came down in the fear indicator. 2003, we had a big rally in the S&P 500. Why? This went at the bottoms, and for 2004, 2005, 2006, and then we had a small breakout in that fear indicator at 3830. But then abruptly, the market had put in a bottom in the S&P. It rallied up, but then we pulled back for 3 months, and we got into 2008. And look what happened. The fear went to all-time highs. The housing market bubble, Greenspan, Bush, Paulson, the new FOMC chairman hadn't been in office yet. Then Bernanke, the housing market bubble, everything popped. When everything popped up here, the fear level was as high as it could have ever been. That was when markets were putting in a bottom, and that was time to buy. Yes, I can repeat that again. And we had that big rally that started 5 years ago in March. How about that? Take a look here. This is 12/1, but when we get back over here, you can see that that was 10/1. October, oh my goodness, look at the big spikes that came on 9/1. We went straight through the roof, and everybody hated the stock market. But then we put the bottoms in, and we got this fear indicator all the way back down. Now, what I can say is, I'll be proud to say one thing. I said that volatility is going to increase substantially. The big money has already been in the market since the 5-year anniversary date of the March 1, 2009 lows. And when the 2009 lows were put in on a monthly level, it came down and there wasn't no fear. Then we had market reversals. This was just in the beginning area. But now, on a monthly level, we're very complacent. Just as it was in 2006 and 7 and 2008 and 9 came into play. This is the bottom of the fear. Look at, we rallied up big time in year 2000, and that fear stayed right there. Now, it's a monthly move now. Now, look what happened here now. We peaked. We peaked in the fear indicator right here at around 120, let's call it this. On the monthly level, 2148 was the calendar month of 2/1 of 14. When we hit those highs, the markets put in their bottoms and we came straight down. Now, for the January mode, we were as low as 1432 here, and the high at that time was 1889. It is the best way to gauge a market. Now, after 32 years of experience with markets, I can tell you here that in 2011 we had a 10% correction. Now, ever since the rally started, the major part of that bull breakout was in this year. And we are at historical lows that we have not seen for many years. And everything was great in 2013, but 2013 is over. And D is the 2014 mark right here. So you can see how complacency, there is no fear in this market, meaning that the market is back in an overbought stage right now on the S&P 500. Yearly chart that we've been showing is when the fear peaks. You can see the complete 2012. Hey, the minute that we got that monthly low right here, we were at the monthly low and we stayed across here forever. Now, having said that, here is the same chart on a level, and it's called a daily level. Now, one of the things that we're going to show here, it's the VIX, it's the same thing, but it's done on a daily level. Now, in calendar 2014, let me just tell everybody something right now. Because I showed it now, look at, I want you to see the peaks. I want you to see the peaks of this fear. When we had a sell-off over here, we called this big correction was a pullback, and the fear went straight up. Yes, it's on the stockmarketfunding.com website. Here, one thing that you can do is you can simply go to the stockmarketfunding.com website. You can go to trading. That's what you can do. That's the home page. We do all the live analysis before the fact. Everybody loves something when it's already said and done. That doesn't make money, and a 2-year-old could say that, for crying out loud. The thing that I want to tell you is that these fear indicators really represent the lows and the highs. All you have to do is type in the search box, hit go, and you'll find out all the analysis on the fear indicator at stockmarketfunding.com. You want to open an account? You're welcome to. And you're welcome to get trading capital for what's left in this bull market. Hit open an account. Get started today. In that trial period, we're going to answer your questions and whatnot. So, we have had some pretty decent ranges. Back in May of 2013, we had a big, nice sell-off, and we made that high. Markets put their bottom in, and that went straight up because it did. And here's what I'm going to show you. Here, we have a daily chart of this S&P 500. And you can clearly see that in the calendar months that I'm going to show you is the following. And what we're going to do is that when the markets had their big rally here, that was the top, and we were going to have a pullback, and we did. Now, here's the thing. In May, when the markets went straight down, now look what happened here. Behind us, you can clearly see that the fear indicator was going up, and the market was selling off. Then when that sold off, markets went back up. When markets had another pullback right here, this, of course, went straight up. And that's a major resistance. Every time they put that higher level in and start to go down, that's when you want to be a buyer in the S&P. And not only that, we have clearly stated that this big move down right here, this whole big move down in January is when this January, that fear went to the top. And when it started to come down, that's when we got the rally back in the S&P 500. Because you can see here, Yes, you can. When that was coming down, we started that rally back up and made an all-time 2014 high at 1867. When that peaked and gapped down, that was part of this move. And you can see how that fear indicator has come back in the volatility index. It's at 14. Right now, I said before the year started, there was going to be tremendous price volatility. Why? We are hitting the upper end of the all-time highs. It's going to take a lot more money to push that through there. And it's going to take a lot of foreign investors to come in and start buying our markets as whatever they want to call it. Safe haven? So be it, safe haven. Come on in. Well, monetary policies played its role, and we know what Ben Bernanke did with the QE all the way up to QE3, steroids being pumped in the system, artificial movements, because let me tell you something, we're only growing at about 2% GDP. Come on, people, give me a break. I am telling you that right now we are at the counter trend. I'm showing you, and this is part 3. You already have in part 1 and part 2 the S&P. I'm just letting you get very familiar with how we peaked and how that went straight down and how we rallied right back up. And that volatility in 2014 is here to stay. That means that the bear gets a rally, the bull gets a rally. And I can tell you, we are simply one of the greatest referees in the world. And why do we say that? Because we are the referee between what the bull does and what the bear does. I mean, we do not represent one or the other parties. We don't. And we could care less. If the bear is in control, we make money. When the bull's in control, we make money. For us, it doesn't matter. For you, it matters, and everything matters for you because you got to take responsibility. And let me just tell you something else. So for the new MMTs and the ones that are coming on board, for you new people, go to HFT Trading Courses. Once you get there, I want you to understand high frequency trading. I want you to understand who is behind it and how unfair of a practice it is for you. Now, what you can do in here is you can come to the Ghost Exchange. I called the flash crash in May, and then the market and the Dow and everything sold off very hard, and there was a capitulation. And we are telling you that you need to know who is behind it. We encourage you very much to watch this high frequency documentary that we put together. Stockmarketfunding.com is in there. Listen, go through it. You'll be able to relate to why it's an unfair practice to the retail buyer and seller in markets. I am calling for another pullback. I am going to say that for the rest of this year, we have hit that 5-year anniversary, multiple expansions. Yes, we could still continue to go up, but no, the ranges are going to change. And then, listen, folks, 60 months. 60 months. Yeah, 60 months here. Right here in 2009. It started. The public never wanted to get in. No, they were fearful. Everyone had lost their money. People were washed out of the market. But there was a fortune to be made right here. Now, I'm going to say that between the bear and the bull, that the bull has the upper hand. Because, listen, I'll just make it simple. Here's how simple it's going to be. This is the link. That's the 2009 low. Now, listen, the big crackdown wasn't really that far. You can see how much further here that the bull is in the tape. And you know what? Markets have a way of putting in great bottoms and 5-year rallies. But let me tell you something, it's not going to last. You know why? Because there's a lot of economic damage. Listen, free money, cheap money is not the way that prosperity, nor is it the weekly, hourly wages are not going higher. They're going lower or staying at about where they are. But the price and the cost to the consumer is at all-time highs. Listen, the 5-year rally is over. A new 12-month process starts March 1. We are going to watch this consolidation on the daily. It's not as low, but right now there's that pullback to that trend line and it's consolidating. If we get down in here to the pocket, that would mean the markets would go higher from here, that at some point the fear will return. Fear is when markets sell off. Fear is when markets sell off. Fear is when markets sell off. And ultimately, 2014 is going to have a huge consequence because the big money's already made their money. Easy money's been made. Look, when we have great rallies, we come straight back down in that fear indicator and markets go up higher. It's paid to do that in 2013. But let me tell you, this is the daily S&P 500 VIX Market Volatility Index CBOE that measures the fear between who? The bear and what? The bull. Part 3 of part 1 and 2. This goes with part 3, and good luck to all of you because you're going to need it.